Like it or not, banks are the masters of our financial universe. And over the decades and even centuries of existence, they've uncovered a number of financial truths, which have been turned into strategies to maximize their profits. But knowledge is power, and being aware of these schemes can tip the balance in your favor. From the intricacies of interest to the nuances of customer loyalty, we'll walk you through these banking truths and, more importantly, show you how to turn this knowledge to your advantage. Whether you're aiming to grow your savings, manage your debt, or simply become more financially savvy, join us as we demystify the banking world and equip you with the tools to make your money work harder for you. Number 1. Compound interest. Compound interest is the process where interest is calculated on the initial principal amount, plus all interest that has accumulated and hasn't yet been paid on a deposit or loan. It's often referred to as interest on interest, and it can make money grow at a rapid rate compared to simple interest, which is calculated only on the principal amount. Banks are masters at leveraging compound interest. When you deposit money in a bank, the bank often pays you interest on your deposit. Concurrently, they lend out a portion of these deposits to others at higher interest rates. When they earn interest from those loans, they don't just earn interest on the initial amount, they earn it on whatever amount of interest was unpaid as well. Over time, this allows banks to accumulate wealth at an exponential rate. As a consumer, understanding the power of compound interest can be transformative for your financial health. When it comes to credit cards, always ensure that you pay off your balance in full every month so that you don't get hit with interest charges. Those can very easily snowball, and you'll be paying interest on interest. On the other side of the ledger, start saving and investing as early as possible, even if it's a modest amount. With the passing of time, even low interest rates can result in substantial growth due to compounding. If you invest in avenues like retirement accounts or other investments, the compounding effect can significantly boost your savings. And also be aware of the frequency with which your interest is compounded, whether daily, monthly, or annually, as it affects your returns. Number 2. Overdraft and miscellaneous fees. Overdraft and miscellaneous fees refer to charges that banks impose when customers withdraw more than what they have in their account or breach certain account terms. These fees aren't just punitive, but are also a significant source of revenue for many banking institutions. Many banks use sophisticated systems to track and automate the charging of these fees. For example, if an account falls below the required minimum balance, or if a withdrawal causes a negative balance, the system automatically triggers an overdraft or similar fee. Over the course of a year, these fees, which might seem inconspicuous on individual transactions, can accumulate to constitute a substantial part of a bank's non-interest income. It's crucial for us as customers to be proactive in managing our accounts to avoid these fees. This includes setting up account alerts for low balances, understanding the fee structures of our banks, and regularly reviewing statements. Some banks offer overdraft protection services which can automatically transfer funds from a linked savings account or credit card to prevent an overdraft. And also, always be vocal. If you're charged an unexpected fee, it's worth contacting your bank to inquire or negotiate a reversal, especially if it's a rare oversight on your part. As they say, the squeaky wheel gets the grease. Number 3. Interest rate margins. Interest rate margins represent the difference between the interest rate banks pay on deposits and the rate they charge on loans. This so-called spread is one of the main sources of profit for banking institutions. Banks borrow money from depositors and pay them interest, often at a pretty low rate. They then lend this money out to borrowers at higher interest rates, like personal loans, mortgages, or credit card interest rates. This difference, or margin, between what they earn from loans and what they pay on deposits is where they make much of their profit. Factors like central bank rates, competition, credit risk, and overall market conditions can influence the size of this margin. Because of this, it's essential to be savvy when borrowing and saving. When borrowing, always shop around. Don't just accept the first loan offer you receive. Look for options like credit unions or online lenders which might provide competitive rates. When it comes to deposits, seek out accounts with higher interest rates to earn more on your money. Remember, in both scenarios, understanding the market and negotiating can lead to better terms and rates. Being informed and proactive is the key to ensuring you're getting the best deal possible. Number 4. Tiered interest rates. Tiered interest rates refer to the practice where banks offer different interest rates based on the amount of money deposited or borrowed. Simply put, the more money you have in your account or the larger your loan, the different rate you might receive. Banks employ tiered interest rates as an incentive mechanism. On the savings side, they might offer higher interest rates for larger deposits, encouraging customers to deposit more funds with them. On the loan side, they might offer lower interest rates for larger loans, reflecting a perceived lower risk with those who can afford bigger loans, or as an enticement for large loan customers. Understanding tiered interest rates can provide strategic advantages. If you have savings scattered across various institutions, consolidating them might push your total balance into a higher interest bracket, earning you more. Of course, you should only do this with reputable, licensed institutions so as to safeguard your hard-earned cash. On the borrowing side, be aware of the tier thresholds. Sometimes borrowing a slightly higher amount or placing a larger down payment to reduce the loan size can qualify you for a more favorable interest rate. In both scenarios, it's essential to do the math and ensure the interest benefits outweigh any potential fees or other costs. Number 5. Bank account promotions. Bank account promotions are special offers that banks provide to attract new customers. These can range from cash bonuses, gift cards, to other rewards for opening a new account and fulfilling specific requirements. The banking sector is fiercely competitive, and acquiring new customers is often more costly than retaining existing ones. As an incentive, banks regularly roll out attractive promotions for those willing to switch or open new accounts. They bet on the long-term value of a customer, hoping the initial cost of the promotion will be outweighed by the profit made from the customer over time. For the discerning consumer, bank account promotions present a golden opportunity. If you're considering switching banks or opening a new account, keep an eye out for these promotions. But always read the fine print. Ensure that any requirements, like minimum deposits or a certain number of transactions, are feasible for you. By fulfilling the criteria and claiming the bonus, you can enjoy a nice financial boost. Just be wary of hopping between banks too frequently, as this can sometimes negatively impact your credit score or lead to other unforeseen consequences. Number 6. Loyalty doesn't always pay. While it's human nature to stick to what's familiar, in the banking world, loyalty doesn't always equate to the best deals. We saw this earlier in how banks often attempt to lure new customers with better interest rates, promotional offers, or waived fees, sometimes at the expense of their existing clientele. Clearly, the industry is extremely competitive and maybe even cutthroat. Growing is the name of the game, and banks need to consistently attract new customers. As such, they invest heavily in marketing strategies tailored to entice new clientele, including special offers, discounted loan rates, or promotional deposit rates. And in many cases, very unfortunately, these lucrative offers aren't always extended to existing customers who might be on older, less favorable terms. Being aware of this dynamic empowers consumers to stay vigilant. Regularly review the terms of your accounts and compare them with offers in the broader market. If you come across a more appealing deal, don't hesitate to approach your bank and negotiate. Given the high cost of customer acquisition, many banks are open to renegotiation to retain an existing customer. However, if your bank isn't flexible, consider switching to where you'll get better value. Just be mindful of potential switching costs and any implications for your credit score. Check out these videos next on other tips and tricks to save better.